First of all, good afternoon, ladies and gentlemen. Thank you for taking the time out of your busy schedules to join our webinar today as we discuss all things US tax for Americans living here in the UK. I'm Cam, and I'll be the moderator of this webinar alongside our excellent roster of panelist speakers, who I'll be introducing shortly. But before we do so, just a few housekeeping rules here really quickly. This webinar is being recorded, and the recording will be shared at a later stage afterwards for the participants to view in your own time and at your leisure. Again, if you do have any questions, please put them in the Q&A, which goes straight to the panelists and only they can see them. Whereas please note, if you do type anything into the chat, it will be public. So if you do have any sensitive questions, please save them for, afterwards. And, we'll be sharing the contact details as well of all the respective speakers. So you can get in touch to get their expertise in their own time. Now, before we dive in, just a few disclaimers to go through for compliance, so just bear with me. The information presented here is for educational purposes only, and it's not intended to make any offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional, which I'm glad we've got both sides represented here in this webinar, before implementing any strategies discussed herein. Now, with that out of the way, let's move on to the guest speakers that we have today. So first off, we've got Nathan from Partners Wealth, who's the partner and head of internationals over there, working not only with UK-based families, but also those who are non-domiciled in the UK that have personal US tax considerations. Before joining the firm in 2015, Nathan worked at a variety of other wealth management firms, such as Merrill Lynch and Julius Baer, and is now recognized as one of the leading independent advisors for US citizens here in the UK. Moving on, we've got Chris Baker, International Tax Director at More DM. Chris is the tax director at the firm's London office with over 20 years of experience on the expatriate side here in the UK. And again, over his career, he's developed an in-depth understanding of the complexities of US tax for Americans living abroad. Again, that's a topic that we'll be discussing in great length here in today's webinar here. Moving on, we've also got Joshua Reeve from More DM again, a senior tax consultant who provides private client US tax advice and compliance for international US taxpayers as well, in addition to non-resident aliens who have a US connection, whether it's for any income or assets that they might have. Josh also assists with individuals and families navigating the US tax complexities of foreign investments, foreign trusts, as well as foreign corporate structures. So again, a wealth of knowledge there in regards to those aspects. Last but not least, we've got our very own Anya Berzwa, who's our certified financial planner with over a decade of experience in the investment and banking industry. As an American expat herself, she enjoys helping other Americans who've made their home outside the US, and her main goal is to simplify the overall financial planning process. Now, with that out of the way, I guess I'll hand it over to you, Josh. I know you've got quite the agenda here for us, so take it away.
Yeah, perfect. Thank you for the introduction, and it's a pleasure to be here. So I'll just bear with me while I share my screen. Let me know when that's up. It should be up now. Perfect. Cool. So a quick brief background on More DM. So we specialize in US tax advisory services and compliance services. We've got offices based in the US, across Detroit, in Michigan, which is our kind of head code, and then Texas, Florida, North Carolina. And then we've got our London office where myself and Chris are based, as well as a Swiss Zurich office as well. So this is a little bit about today's agenda, what we're going to go over. So myself, Chris, Nathan, I think Cam might jump in a few times as well. We're going to discuss these topics kind of at a high level so that we can cover a wide variation of topics and then leave some time towards the end for kind of a Q&A style session as well, if you have any specific questions you would like any of us panelists to answer. So we'll, without further ado, jump straight in. So filing deadlines. As some of you may already be aware, the filing deadline is April 15th. What I wanted to note out here for Americans moving to the UK, so for American or US taxpayers who live overseas or outside of the US, they do qualify for an additional 2 months extension without the need to file an extension. So that would take you to June 15th. This does not extend your time to pay, similar to the typical 6-month extension that you would file to extend to October 15th. So whilst living overseas, just know you've got that kind of breathing room of 2 additional months to get your returns filed. Also within this topic, the FBAR, that will follow the federal extension as well. So if you extend with the additional 6 months, that will take you to October 15th. Again, with living outside of the US, if you do file your additional 6 months and take yourself to October 15th, you again can qualify for the 2 months extension automatic, so through to December 15th. That can be done by writing a written letter to the IRS and requesting that. That can just go in, ask your tax advisor to kind of write that up and send that in for you. So next up, a little bit on foreign tax credits. So for foreign taxes to be claimed on your US tax return, there's kind of 3 key elements that need to be met. First of all, they need to be owed and paid by you. Second, they need to be assessed on taxable income. And third, they need to be paid to a foreign country. Once you've determined whether your taxes paid to a foreign country are qualified, you'll split your income and your taxes paid into kind of 7 baskets. Out of the 7, the most common baskets that we will see will be the passive income basket, general limitations basket, and the income resourced by tax treaty basket. Example of passive income would be, or foreign passive income would be foreign interest and dividends. General limitations would be your foreign employment income or self-employment income. And then your income resourced by treaties, that may be US interest that would be taxed on a foreign tax return. So if your income falls into some of these baskets and you have available credits, you can use these credits to offset your US tax, essentially. So you're not going to be double taxed when living abroad. One thing to note as well is there are a few tax rules and systems in the US, such as the net investment income tax. So that's also known as NIT. That's a tax assessed on worldwide investment income. Regardless of whether the investment income is US or foreign, the net investment income tax charge, which is 3.8%, cannot be offset by foreign tax credits. So again, even if that's foreign dividends, you'll be subject to a 3.8% net investment income tax charge in the US that unfortunately the IRS won't recognize a foreign tax credit for. So some additional filing and penalty exposures. So some things to note. So being a US citizen living abroad, there are a breadth of foreign investments, foreign holdings and interests that you can have and you can accumulate whilst living abroad that may trigger additional filing requirements that you wouldn't necessarily be used to filing with a standard US resident return. So for example, kicking off with the FinCEN Form 114, also known as the Foreign Bank Account Report. If you have foreign bank accounts with an aggregate value of more than 10,000, you must file this by April 15th. And again, you can extend to October 15th, and you can't extend any further. Failure to file FBAR can be quite prudent. The penalties can range from 100,000 or 50% of the balance of any emitted account or accounts. If you emit multiple accounts, then those penalties can really rack up. So when moving abroad and opening foreign accounts, whether that's a bank account or a foreign pension, it's key to notify your US tax advisor that you've got these. And if the value of those are more than 10,000, you will need to file this form. With the 8938 next on the list, it's similar in what is reported on the FBAR, although it will also report your foreign assets alongside your foreign bank accounts. So foreign assets may be individually held shares, pensions will fall into that. And again, that will boast prudent penalties if not correctly filed or timely filed. The threshold for this is a little bit more lenient. Rather than the $10,000 in a year, the maximum threshold, or the threshold, sorry, is $200,000 towards the end of the year, or $300,000 maximum value at any point during the year for a single filer. That threshold doubles if you're married filing joint. So at any point in the year, if your bank accounts are $600,000 or higher, you will need to file the 8938. With Form 3520, this is essentially to report any gifts or any transactions, any foreign gifts, sorry, so any gifts from a foreign individual. If they exceed the threshold, this will need to be filed. So some of the key points to note on this with the penalties is there can be a penalty of up to 5% of the value of the gift if not correctly reported or timely reported. Just because I know we want to save some time for some Q&A towards the end, to briefly go over the last few, the 5471, that's a report of an interest in a foreign corporation. 8865, a report of an interest in a foreign partnership. These forms also boast around $10,000 penalties if not correctly or timely filed as well.
And actually, just to touch on that, if you don't mind, Josh, we had a question come in, which is actually related to some of these items from Bruce Weinstein. But are the forms 3520 and 3520A required to be filed for UK SIPs?
Yes. So with a UK SIP, they are typically written under trust. And what that means is, from a US perspective, although from a UK perspective, a SIP is a pension, from a US perspective, they're viewed as trusts. So a Form 3520 and a substitute Form 3520A should be filed to report that, yeah.
Perfect.
Within the UK, there can be a treaty claim as well to exclude the income on a horizon basis, and so it would more necessarily be taxed upon distribution. But that's a conversation to have with the US tax advisor, whether you want to claim that treaty position or not.
Thank you, Josh. The question I had, or an observation I had, one of the points that you made there about tax credits being on a tax paid basis.
Yes.
One of the things that we often kind of encourage our clients to do is to talk to their tax advisor about making their UK tax payments perhaps not on the 31st of January when the UK tax deadline is, but perhaps in December the year beforehand to align with the US tax year. Is that something you would be kind of frequently talking to clients about?
Yeah, I would agree with that. If the tax payment can be made within the calendar year relating to the US return, it makes aligning the US and UK returns a lot easier. If for whatever reason the taxes don't align and the tax is paid in the following tax year, then the accrual basis can be taken. But one thing to note is, once you've elected the accrual basis, you cannot revoke that, and you will have to remain on the accrued basis for the remaining time you file a US return. And essentially what the accrual basis is you will be able to claim foreign tax credits on your US return for taxes that relate to the US tax year, as opposed to taxes that were paid within the US tax year. So it's just something to note that planning can be done, but once elected, you can't revoke the accrual basis.
And it is interesting, actually, with the accrued basis. I'm so used to working with people based in the UK, where we have that peculiar tax year that ends on the 5th of April, which I believe relates to medieval farm rents, because that's how the UK like to operate. Most of the rest of the world are on a calendar year basis. So the accrued basis is more often claimed than the paid basis, unless you're in the UK, where doing, as you've suggested there, Nathan, accelerating the payment to make sure it's paid in the calendar year, that gets you the credit where it needs to be. For a UK accrual basis, you take the tax liability for the year ending on the 5th of April. So for a 21-22 UK tax return, that is the tax credit that falls on the 2022 US calendar year. So you have a mismatch of where the income and the credit, it can cause problems, the accrued basis with the UK. If people's income is increasing, they're always a little behind. And these days, again, I'm showing my age, it's been for a long time now, but there is a 10-year carry forward of foreign tax credits and just a 1-year carry back. So if you end up with a shortfall, you've only got 1 year you can go back. So there's a limited window to solve any problems because your client forgot to pay in December, or there's an issue with the accrued basis and the UK April tax year end.
Yeah, all right, thank you.
US citizens and investing abroad. Is that over to you, Chris?
Yes, so again, talking about the UK broadly, and this would apply to much of continental Europe as well, but would be different in, say, Hong Kong and Singapore. When we're looking at using foreign tax credits to offset the US tax liabilities. So in theory, a UK resident US taxpayer is unlikely in most cases to owe US tax because the UK income tax rate is higher. So there should be a full offset. So there are certain areas where we don't end up with that offset because the US will treat certain types of investment differently. And the passive foreign investment company is one of the areas where a US person overseas can still end up with US tax liabilities, because under these passive foreign investment company rules, the PFIC rules, there is not available a foreign tax credit for the prior year portion of the income. So sort of one of the default questions you'll always ask an individual when they first come to have a conversation with us is as simple as, do you have a stocks and shares ISA? Because almost certainly an ISA of that nature is going to be invested in PFICs.
Actually, that's a great segue there, if you don't mind, Chris. I think we've got
Sure.
one of the polls here, which is, I think if we can get the first poll up here, just to get a read on the room of where you hold your investments. Is it here in the UK, the US, or both? Or I guess we should have had another option as well for the more exotic among us here. But you know, I'd be interested to see what the results are. Give that a couple of seconds while that
Sure.
is running. But sorry to interrupt your flow there, Chris. So please do go on while we wait for, I guess, everyone to chime in with their answers on the poll.
Yeah, so when we're looking at these PFICs, and this slide sets out the tests that determine if a foreign company falls under the passive foreign investment company rules, then you'll find any of these sort of open-ended investment funds, foreign mutual funds, they're almost certainly PFICs, and you see those as broad investments. It's also the case where individuals have their own companies, again, without getting too involved. If a US person or US persons own greater than 50% of a foreign company, then we're into the controlled foreign corporation rules. If the ownership by US persons is under 50%, then there is a risk that the foreign company becomes a PFIC. And the test, again, we hear this word passive a lot. That is broadly defined, as Josh has already covered, but that's rents, interest, the income that it accrues on your investments. So if 50% or more of the assets are generating passive income, then you've got a passive foreign investment company. And if 75% more of the income of the company is passive in nature, again, you fall into it. The thing that can make a trading company a PFIC is having cash on the balance sheet, because under these rules, cash is a passive asset. And so that can create problems where you've got US persons who are minority shareholders, even in trading companies. But most commonly, we're seeing these where an individual has got an investment fund in the UK, hasn't spoken to someone, a wealth manager, an investment advisor who is aware of these rules. Where I have clients who have an advisor, I generally just ask them, just ask your advisor if they know what a PFIC is. And anybody working in the US, UK space who understands what a US person needs to be invested in will know that phrase. If your investment advisor comes back with a blank expression, then you probably need to be speaking to someone else, because once you're in these investments, the tax consequences are quite punitive, which I think is on the next slide, Josh. So the default taxation essentially treats the investment as if it should have been taxed in each year that you owned it. So if you hold a mutual fund, a foreign mutual fund for 10 years, the IRS will say that you should have paid the tax each year over the 10-year period, and they will impose an interest charge as if you are 10 years late on paying your tax on the earliest portion of that holding period. The tax for the prior years is calculated at the highest rate in that tax year. So at the moment, we're in a 37% rate, and there is no foreign tax credit to offset it. If you're in an ISA, you're not even paying UK tax, so there wouldn't be any foreign tax credit. But because the prior year portion is not offset by a foreign tax credit, this becomes a real tax hit for an American who has inadvertently invested in what are passive foreign investment companies. There are two elections available, which again, I think is the next slide, Josh. The qualified electing fund election, the QEF election, this would probably apply to that individual who is a minority shareholder. So we don't have a controlled foreign corporation, but this is their business. They will have access to the books and records. They will be able to get the company to provide those as required. So the IRS, under this election, you are saying the IRS can review the books and records of the company. If you're one of thousands of investors in a mutual fund held in an ISA, you are not going to get the company to provide its books and records. So where you've got a real trading company that's fallen foul of the PFIC rules, the QEF election might be available. But if it's a broad, open-ended investment company, you're not going to have the option of taking this election. Under the QEF election, what you're essentially saying is, I will pay US tax on income I haven't yet received. And again, the problem for US people overseas is the US government, the IRS, do not trust foreign deferral schemes. So all of their anti-avoidance in many forms, not just in the PFIC, in the controlled foreign corporation world with GILTI, you're looking at having to pick up on a current basis income that you haven't necessarily received. So you get hit with a dry tax charge where you're you're paying tax on income that you haven't actually received. And the alternative election on the next slide, the mark-to-market election, it's essentially the same thing. You are electing to pay tax on the current growth within your investment, even though you haven't realized that investment, so you don't have the funds to pay the tax. The mark-to-market election is only available on publicly listed funds, and a lot of the funds in an ISA are not actually going to be publicly listed. They're going to be specific to the provider. So the mark-to-market election is available, but in practice, we don't often have the opportunity to make it. Again, that's kind of just covering more complicated structures where within family structures, foreign corporations, partnerships, trusts, the investments within those become, if they're PFICs, taxable to the individuals who are the ultimate beneficiaries. So I feel like I've gone on about PFICs quite enough for now, but there are, again, when you're doing the checklist, the health check of someone who comes through the door, there are other areas where we might see a US tax charge where we haven't got a foreign tax credit to offset it. And one of the reasons you wouldn't have a foreign tax credit is where you're not being taxed in the other country. So what we're looking at here is a mixed marriage, as we would describe, where you have one US spouse and one non-resident alien spouse. Now there are elections available for the non-resident alien spouse to be treated as a US person, but then you're bringing all of their income and wealth into the US tax net. So where you have a US person married to a non-US person, then owning investments, property separately is a way of managing US tax liabilities. And again, we'll talk a bit more about gift and estate, but the annual gift to any person is $17,000 a year. For the particular to a non-resident alien spouse, that's $17,000, it becomes $175,000. So without having to file gift tax returns, assets can be passed from US to non-US spouses.
Interesting. I
We
think
have
it's
one more poll. Oh, sorry.
yeah. I think perfect segue there, Josh. I think it's time for a quick pop quiz, which is our second poll of the session here, just to get a gauge of the audience. So let's see if we can get the second one up here, which is your UK pension reportable in the USA?
Whilst people are answering that question, I'll just chip in with a couple of comments on that previous section, just kind of overlaying onto what you don't want to do when you're a US person investing abroad, i.e. avoid PFICs at all costs, is what I was hearing. and kind of overlay with that, when you're in a jurisdiction like the UK, also, of course, being very mindful of what the UK's tax rules are. So, you know, one of the things that a US citizen abroad might look to do is to avoid PFICs by buying predominantly US domiciled funds. But of course, if you're taxable in the UK, you need to be mindful of how those would be taxed here in the UK and consider the UK reporting status rules on having funds that report appropriately into the UK. Now, there's only a very few number of US funds that have that status, so be mindful of that. Very much, Chris, your comment on UK ISAs, I think, is something we see quite frequently. People have built up ISAs over time, and predominantly those do end up getting invested in funds. ISAs themselves aren't necessarily an evil thing, but the funds that you buy are. If you do want to use an ISA, then obviously just make sure that you're avoiding PFICs, perhaps just buying individual shares in those ISA wrappers. Very unlikely to be able to buy US domiciled funds in an ISA, so you will be limited to individual shares there.
Perfect. I think we've got the results of our poll here with an overwhelming 71% voting yes, that you do have to file your UK pension on your US tax returns. Now, do we have any of the experts here to weigh in on that verdict, whether that is indeed true?
Of course, it's true. Trick question. As any US person getting used to life living outside the US will learn, reporting everything is the main burden. The IRS, FinCEN, in the case of the FBAR, they want to know everything about what you're holding outside the US, and absolutely that applies to pensions. So because of the US-UK double tax treaty, pensions is actually an area where a US citizen or green card holder can achieve some tax deferral. And really, normally a US person, if they're not paying tax in one country, they'll be paying tax in the other. The pension allows, under the treaty, the pension allows deferral in both jurisdictions. So again, to talk broadly, a UK pension plan is not a qualified pension under US rules, under the Internal Revenue Code. So the default treatment is there would not be a deduction for the employee's contribution into the pension, and the employer contributions would be additional taxable compensation. Under the US-UK income tax treaty, the matching equivalent treatment to a US qualified plan of 401k, the employer contributions can be excluded from tax, and a deduction can be taken for the employee contributions. Now, particular to the UK, to the continental Europe, and jurisdictions where we have a higher tax rate than the US federal rate, we will, in the general basket for foreign tax credit purposes, we will often see excess credits building up, that 10-year carry forward. And by choosing to tax the employer contributions, you subject those contributions to US tax, but you don't actually have to write a check because you have excess foreign tax credits that will offset the US tax on the employer contributions. That way, the US taxpayer is actually building up basis in their pension pot. So when as long as the basis is tracked year on year, then when it's time to take distributions from the plan, there will be a lower taxable amount in that distribution because you've already paid tax, even though it was offset by your excess foreign tax credits. You've already paid the US tax, so you've built up basis in the plan. So again, I think we've sort of touched on again, because it's a painful answer for US individuals. This doesn't just apply to SIPs, but SIPs are the most straightforward, clear cut. A SIP is a self-invested personal pension. If you as a US taxpayer have control and have made the contributions into a plan, and that plan is written under trust, then as far as the US are concerned, you have a foreign grantor trust. Now, that leads to the 3520 and 3528 reporting. I think 2-3 years ago, they introduced the substitute form 3528. So that follows the individual, the April 15th, June 15th filing deadlines. A 3528 that is not a substitute form, so for a genuine foreign grantor trust, that has its own filing deadline of the 15th of March. So the substitute form saves us from having to put in extensions in for this foreign pension reporting, as it essentially is. The 3520 and the 3528, they, as a default penalty for late filing is $10,000. They can get worse. They can be based on the value in the trust, so in the pension plan. But the office, the IRS office that deals with these forms is Ogden in Utah, and they seem to send out notices almost as a matter of course, and then you have to go back and make a reasonable cause argument that says this penalty should not be due. But any communication from the IRS, it's always difficult, it's always time consuming, so we try to head it off. The filing for the foreign pension as a trust is essentially, it's the conservative position. We do not want to fall foul of Ogden and its penalty notices. So we file the foreign trust forms, but underneath that, we fall back on the tax treaty and exclude the income and growth within these pensions. So it's more filing, but it covers the IRS requirements. I think, again, this is another area that comes up. It's peculiar to the UK. The PCLS is the tax-free lump sum that is allowed in the UK. Lump sum is a problematic phrase because there's a distinction in the treaty between what is a lump sum and what is a regular payment from the pension. Nowhere is lump sum actually defined. Under the treaty, we can find a position that says the 25% tax-free in the UK should be honoured by the US. Again, we're seeing that the same phrases coming up again and again. It's the information reporting the US needs. We've got our FBAR, we've got the 8938, which is part of the tax return. The FBAR is a separate filing. If you fail to make the information reporting, you expose yourself to penalties that are not tax geared, that are just fixed penalties. Again, I'm conscious we're running a little low on time here, but if we just cover briefly the gifts and estate side. The UK does not have a gift tax regime. The US has a combined gift and estate tax regime. In the UK, if an individual makes a gift and survives it by 7 years, it has left their estate, and that is the end of it. If they die within 7 years of the gift, then some of the value is clawed back into their estate. So it's not part of the gift, it's part of the inheritance tax that gets charged. Currently, the US has a historically high exemption for gift and estate tax, $12.9 million, where you have a married couple who hadn't used, the first to die does not use the 12.9 million, that can be assigned to the surviving spouse. So you're getting up to nearly 26 million exemption on an estate. that is due to expire at the end of 2025, when we'll go back to, well, it's an index linked 5 million, so it'll be about 7 million, unless there is new legislation to either extend the current regime or change the rates. So yeah, I think that covers. If there's any questions on the gifting and the estate tax, then we'll cover them.
Perfect. Thanks very much for that, Chris. I think before we jump into the Q&A section, we've got a number of excellent questions coming in. We'll throw up our last and final poll for the session here, which if we get that up, which is, do you plan on making lifetime gifts or leaving an inheritance? Now, you know, it's always an interesting topic that comes up, and I guess with the complications of the cross-border issues, that could become potentially quite convoluted at times. So while we wait for everybody to take a stab at that last poll, why don't we sort of jump into some of the questions here that we've got. Again, we've got quite a plethora, so we might not be able to get to all of them. So apologies in advance. Let's pick out a couple of them. So we've got a question from Rob here, and again, this is out to the entire panelists, so feel free to take a stab at whoever thinks they're up to it. What ownership, trust company or other, can a US property be put into to avoid paying second home stamp duty in the UK? The HMRC counts my US home as a first home. That's a bit specific question, but does anyone want to tackle that?
I'm not sure. Unfortunately, putting a UK residential property into a structure will necessarily help with the avoiding of the stamp duty there. And in fact, you know, perhaps Josh and Chris, you can expand a bit more, but I think it'll probably add more tax questions and issues to it rather than the stamp duty you might be saving.
Yeah, keeping things simple is often a good answer. I think the question is looking at a US property. So certainly with the trust, the UK will look to the ultimate beneficiary. I must say more DM are US tax advisors, not UK tax advisors. We're conversant with the issues, but a trust will be look to the ultimate beneficiary. A corporate structure could potentially work, though, again, as soon as you've introduced a corporate, you've got additional filing to deal with, so that the savings might be offset. That there would be potentially corporation tax in the UK. There would be filings required in the US. I mean, it's quite common for property to be owned through LLCs in the US. LLCs create problems in the UK. They can almost be treated the equivalent of a bare trust as a look-through, where they're just holding property. But again, LLCs do create UK tax issues because they are not seen as transparent in the UK in the way they are in the US. So you end up with different treatment in the two countries is where you run into problems with double tax.
Perfect. Hopefully that answers your question there, Rob. And again, feel free to reach out to the guys at More DM. I'm sure they have, you know, a wealth of knowledge there on that on their expertise in that manner. We've got the results from the poll here, which is 71% are actually indeed planning to make a lifetime gift or leaving an inheritance, which pretty interesting statistic there. Moving on in rapid fire fashion, since I know we're dwindling down on time, another interesting question, and there's two parts to this question. So Anya, I'm going to throw this one to you from an anonymous attendee, which is Roth conversions, are they taxable income in the UK? Now, before we get to the tax side of things, Anya, if you just sort of give a high-level overview to the audience of what Roth conversions are and why they might potentially want to consider a Roth conversion.
Absolutely. Thank you, Cam. A Roth conversion strategy can often be beneficial for those that are either retired or for those that have lower income during certain years. And so what a Roth conversion is first is moving assets from your traditional IRA, which is pre-tax in the US, into a post-tax account, a Roth IRA. So if we strictly look at the US side of things, let's say you are 65, you're retiring, and you have $1 million in an 401k or an IRA that's pre-tax. Let's say you're delaying your Social Security till age 70, and you will not make any income between age 65 and age 72 when you're required to take distributions out of your IRA. Here you've got 7 years of no income when you could potentially take some of the pre-tax assets from the IRA, move them into the Roth to benefit from a lower tax treatment. Now, that's speaking on the US side and shifting your assets from the left pocket to the right pocket to make them more tax efficient longer term. In the US, that strategy is commonly used and it's very simple. But I would love to throw the second part of the question to our panel to see how is that treated for those that US persons that are in the UK making those Roth conversions.
Again, you're relying on in the US-UK double tax treaty, and you should get the tax-free conversion should be respected under the treaty. So the default UK tax position is it's taxable, but the treaty allows you to get the matching treatment. It's Articles 17 and 18 of the tax treaty broadly deal with pensions, and those articles are what gives you the pensions rather uniquely something that you can get the matching treatment in the two jurisdictions. And the UK tax treaty is not particularly unusual, so broadly speaking, income tax treaties will deal with US pensions.
Perfect. Moving on to our next set of questions here. Nathan, this might be one for you, but is there a benefit to holding an ISA for an American expat without a PFIX at all?
Yeah, so of course the ISA is going to be a kind of a look through from a US tax reporting point of view. So anything you hold in there is still going to be 100% taxable in the US. But probably where your main benefit is going to be is in the difference in tax rates. So if you're being taxed at a lower rate in the in the US than you are in the UK, the more you can move into that ISA environment, the lower your overall tax position is going to be. It might just be that you're paying it to the US rather than to the UK. So that could be quite useful. I guess there might also be uses in whether you have potentially foreign tax credits that you could use as offset against those kind of profits you're making in the ISA. But it's going to be very personal to individuals. Quite a lot of the time, it is additional hassle, additional reporting, and it's not going to be a huge amount of added value, but perhaps over time that small incremental value is worthwhile for individuals who are building up a kind of larger investment portfolio.
Perfect. Let's sift through a couple of these others really quickly. Got so many questions, I just can't keep track of them. Okay, let's got a really rapid fire question here from Ava. Is the 12 million exemption on the US side, is that per year or is that a lifetime exemption?
That's a lifetime exemption. So if you during your lifetime you use up the unified credit as it's called, then that reduces the tax-free estate if you've used during your lifetime a portion of that. Now it is again something to be managed, because if the 12.9 million reverts to 5, probably 7 million, then there may be kind of a one-off opportunity to use up some of the 12 before it's gone, because we don't anticipate that the future reduction will curtail the 12.9.
Perfect. Now we've got about 9 minutes left here, so we're going to really rapid fire through some of these questions. Really quick question from Dean: is tax relief on a SIP contribution taxable in the US? Yes, no.
So with a SIP, you're using after-tax money. It's your cash that's going in, so that there's no tax on that. In the UK, you get tax relief for the contribution. That will reduce your UK tax. So it may be a situation where your excess foreign tax credits offset the reduced UK tax. So very broadly speaking, the UK tax rate is higher. So managing and getting relief in the UK will reduce your global tax burden. And generally speaking, there will be excess foreign tax credits to mop up anything that would otherwise be taxable because you've reduced your UK tax rate. So for a dual taxpayer, managing the UK liability is actually what needs to be focused on.
Yeah, I'd kind of echo that, Chris. I think you know, there needs to be a really kind of close relationship with your tax filer in the US on looking at those credits when you are making your kind of UK contributions. But it's predominantly in the UK where you're making the tax saving, and you'll be using up those US tax credits. Of course, in the UK, you've also got to be mindful of your annual allowances that you have, that you can get UK tax savings on. So there's a couple of different aspects you need to kind of keep an eye on.
Perfect. I think we'll have one more question here, since there's just a lot to get through. I'll take a stab at this, and then maybe Nathan, you can get we can get your thoughts on this as well. It's not really a question, but it's more of a statement, actually, I suppose, from Julian, where it says, it feels like we are doubly punished for being Americans here in the UK with limited options to invest. What are your thoughts on that?
So I think it's you know, it is a feeling I think a lot of people have about feeling punished that you're a US citizen here in the UK. I think, you know, there are a number of additional rules to be mindful of. There are, you know, filings to be made. I wouldn't necessarily see it as punishment. I think it's just to be mindful of, to be efficient as a US taxpayer here in the UK. You need to be mindful of the rules and kind of walk the line in those rules. It's no difference if you're solely a US taxpayer or solely a UK taxpayer. You still have rules to follow. You still have, you know, a balancing act to be as efficient as possible. It's just you've got two jurisdictions you need to be mindful of. We often work with clients that start off feeling like they're being really punished, but actually once you've worked things through, once you've got yourself kind of arranged in a way that is tax efficient in both jurisdictions and efficient in both jurisdictions, you can invest sensibly, tax efficiently, and you can kind of minimize the reporting burden as much as possible. The key is to kind of make sure you're understanding what the rules are, make sure you've got the right advisor team around you kind of helping you get those reporting done correctly.
Perfect. And again, there are options out there, even though it may seem a little restricted, but, you know, getting expert quality advice from professionals is probably the place to start. I think, Anya, you had one question that you wanted to ask, which came up in the Q&As, actually. So why don't we tackle that one last one before we sort of conclude and wrap up?
Absolutely. This is by far the most common question that I receive from our US citizens living in the UK or abroad. And that is, how should I file my tax return using FEIE or tax credit? What are the deciding factors? And that also ties into eligibility for an IRA or a Roth IRA contribution. And so that's why it's an important question. I was wondering if either Chris or Josh could address that.
again, so the foreign earned income exclusion and the foreign housing exclusion, that they are there to simplify life. So I mean, it's ballpark $100,000 of current foreign earned income that you can exclude. If your earnings are under that, then that is the most straightforward way to file your tax return. You can just have a 1040, and you have to say this in American because it doesn't work in English. It's a 2555 EZ, and you've got your exclusion and you've got no tax. Now, if you are in the UK, you're paying 45% tax. Claiming the credit and not the exclusion is a better answer because it builds up your excess foreign tax credits. If you've paid 45% on the $100,000 you exclude, then you have to take $45,000 of foreign tax out of your credit basket, even though your US rate's only 30%, so you're losing that 15% credit. The one thing you need to be careful with the exclusion is if you revoke the exclusion, you cannot claim it again for 5 years. So if you're in the UK and you're building up your excess foreign tax credits, you don't want the exclusion, that's all well and good. But if you're about to move to Singapore or Venezuela or wherever it may be to a low tax jurisdiction, then the foreign earner income exclusion becomes very valuable to you. So you don't want to revoke it, move to Dubai, and suddenly you can't claim that exclusion.
Understood. Thank you so much, Chris. That's very, very helpful. And for those that are looking to possibly make an IRA or a Roth IRA contribution and trying to decide between FEIE and tax credit, definitely consult your tax advisor, but also know that it's kind of a requirement to be on tax credit in order to be allowed to make an IRA or a Roth IRA contribution if you're living abroad. So definitely an important consideration. Back over to you, Cam.
Perfect. Thanks so much for asking that, Anya. And I think we're just about here for time. So once again, I want to thank the attendees for joining our webinar. I want to thank our excellent host of panelists here for their insights and expertise. Again, if you do have any specific questions or if we haven't got to your questions due to time, apologies, but we will be sending a follow-up email, which will include the contacts and links to the various speakers there. So please do reach out to them to get expert advice related to your specific situation in your own time. But other than that, I want to thank everyone for attending, and hopefully you found this useful.